All right, scholars, we're now going to cover fixed assets. And you say, well, wait a minute, we did land. What would be different? Well, I would really depreciate you thinking about that. Oh, that was really bad. Wasn't that a bad pun? I need new writers. I get it, but okay, you get the idea. It's depreciation that's going to be important in this one. What we're going to do is we're going to sell a piece of equipment from the parent to the sub or vice versa. So obviously the asset has been written up, which is wrong. Depreciation has been messed up. We got to fix that. And the gain or loss, gain most of the time, has to be eliminated. So, therefore, when you have an intercompany sale of fixed assets, that has to be eliminated for consolidation purposes until the item is sold to a third party outside. So the eliminating entry, first eliminate that gain. Let's assume it's a gain on the sale of the equipment. Then you also have to adjust the asset back to its original basis, and you have to reestablish the old original accumulated depreciation. That's essential as well. We've got a great example to illustrate this. All right, in this case, the subsidiary sold equipment on January 1 to the parent for $100,000. The equipment had a net book value of $70, so there's obviously a $30,000 gain, right? The difference between the 100 and 70. Now, the original historical cost was 90, accumulated depreciation is 20, 90 minus 20, there's your 70,000 book value. All right, so on that date, on the subs books, they book the cash. Hey, we got a $100,000 sale. They get rid of the accumulated depreciation for 20. They get rid of the machinery for 90. The net of those is the $70,000 net book value. And they say, hey, gain $30,000. Note, that's an internal gain. We're going to have to eliminate that. And then on the parent's book, they bought the machinery for $100,000. And of course, they gave the sub $100,000 in cash. That has to be adjusted. That machinery should not be at $100,000. It should be shown at 70 net. So it should be shown at 90 minus 20. Well, by the way, one extra step. Garrity now believes, as the parent company, that he's got a $100,000 asset. He has a 10-year life on it, so he's going to show depreciation of $10,000 every year. $10,000 depreciation and accumulated depreciation. Notice here, how do we fix this? Well, we get rid of the intercompany gain on the sale, 30. We reestablish the accumulated depreciation of 20, and then we put back, the machinery is at 100, we got to lower it to 90. So we lower the machinery by $10,000. So it goes from 100 down to 90, and we put back the depreciation, the accumulated. So 90, the new net carrying gross, minus the 20 of accumulated, equals the 70 that we will be showing going forward. Well, we also have to fix that depreciation. The original was a net book value of 70. Let's assume it was over the same 10 years. It should have been $7,000 a year. Of course, the parent reported that as a $100,000 asset with a 10-year life. They're showing the $10,000 we showed you in the journal entry. There's a correction of $3,000 every year. So we have to reverse accumulated depreciation by $3,000 and lower the depreciation expense by crediting it for the $3,000 because that is too much depreciation. Well, what about subsequent years? Probably the little curveball here is in subsequent years. Let's say it's the very next year. How do you handle it? Well, remember, that $30,000 went to gain. Well, where did gains go on that subs books? It went to retained earnings. But now, because they're taking more depreciation, it's the original gain of 30 has to be reversed, less the depreciation that was too much of 3. That's why you have 27,000 right now. So the gain should be eliminated, and the prior year's too much depreciation is an offset to it to equal a net of 27,000 as an adverse impact to retained earnings. The machinery, once again, would be lowered from 100 to 90, so you would lower that from 100 to 90 by crediting machinery, and then the accumulated depreciation, which originally on the consolidated statements, we had to put back the 20. Well, now they're putting 3,000 too much in every year, so all we have to do is adjust it by 17. The 20 minus the extra 3 that they put in that they shouldn't have. 20 they should have, 3 they shouldn't. The net is a 17 difference the following year. And then we look at the journal entry to adjust the depreciation. This is the same every single year. This year, the second year, the third year, the fourth year, and so on. You will eliminate the extra $3,000 by debiting accumulated depreciation and crediting depreciation expense. And you'll do that every year until the depreciation is fully utilized or until it's sold to a third party. All right, with that, we're ready to move on to our next module.